Welcome to the IRS Solution Attorney Show. If you have problems with the IRS, don't focus on the negative, focus on the solutions. With the IRS Solution Attorney, Darrin T. Mish. For over 15 years, he's been helping taxpayers with IRS problems reclaim their lives and their financial stability. Now, here's your host of the IRS Solution Attorney Show, Darrin T. Mish.
Good morning and welcome to the IRS Solution Attorney Show. I am your host, the IRS Solution Attorney, Darrin T. Mish.
And I'm your co-host, Katrina Madewell. Your voice is a little deeper than normal today.
That was my radio voice, Katrina. How you doing today?
Doing great.
Fabulous. You know, today we're going to talk about something that's near and dear to most people's hearts. I have a hard time believing that there's that many people that aren't going to be interested in today's topic. It's how to avoid. Oh, I like
this topic. This one's good.
How to avoid an IRS audit. Just take it from me. I handle lots of audits. Not my favorite thing to do, but I do handle lots of audits. The reason it's not my favorite thing to do is because most of the time they don't go that well because people don't have that great of documentation, and I can't just wave a magic wand and make it all go away. So audits are really hard for me to handle because most of the time people's documentation is not great, and significant adjustments are made.
Kudos. This is an excellent show today. I don't know that there's anybody listening that will not want to listen to how to avoid an audit, right? Because not everybody has an IRS problem.
Exactly. And I would think the only people that would probably not be interested would be retired people solely living on Social Security, unemployed people. I don't think they have a whole big chance of being audited, at least in this year, in the year that they're unemployed, or people that just don't work for whatever reason. You know, they don't work and they have no source of income.
And they're probably not listening to talk radio, so we're good.
So we're all good. So let's talk about how does the IRS, how do you win the lottery? The bad lottery. How do you win the bad lottery and get chosen for an IRS audit?
So understanding the selection process, how do they pick me
Absolutely.
For the audit?
So the IRS uses a fancy algorithm called the discriminant income function. That's DIF, D-I-F. We're just going to call it DIF. And every person or every tax return is assigned a DIF score. So what I want you to imagine is for every position that you take on a tax return, there's like boundaries, right? There's things on the low end and there's things on the high end, and all that in the middle is okay. But anything too low or too high, usually too high, if you're talking about expense deductions, is going to be, red flagged by the computer. And at some point, if you get enough of those red flags, then it's going to kick it, in my imagination, it kicks it down the audit chute, like in the Willy Wonka movies. It just kind of goes down this chute, and eventually it ends up on a human being's desk. And that person eyeballs it. He looks at the return and he goes, "Yep, that's one we should send an audit notice on, because if that position is that obviously wrong, then we probably got problems with the rest of the return." One of the things that I do on every case that comes in that's an audit is I look at the return before I look at the audit letter. And the reason that I do that is because I'm trying to guess, for my own experience, I'm trying to guess which position on this tax return is really the cause of this audit letter. And I'm almost always right. It's almost always something that you look at it and you go, that number right there.
Like some big deduction?
That number right there is just crazy. Yeah, it's usually a deduction. It can be, we'll talk about it later on in the show, the different positions you can take that you just really shouldn't, or that they're just ridiculous. But the thing that comes to mind is, I'll give you that example. Remember, we talked about a lawyer recently that I represented, and her car and truck expense was based on so much mileage that her position basically was she was driving from Tampa to Orlando 5 days a week. Well, number one, if that was commuting, that's not deductible. So if you really were driving from Tampa to Orlando every day, 5 days a week for a job, that would probably be characterized as commuting miles. But let's just say
so going to the office versus traveling for work?
Right, exactly. So the rule is if you're going from your home to your office, that's characterized as commuting, no matter how far it is.
Even if they relocate you? Curious question.
Well, if you're relocated more, I think it's more than 50 miles away from your residence, then your moving expenses can be tax deductible.
Oh, so you have to move. I got it.
But in this case, she was just driving around at different courthouses and different places where dependent children were and stuff like that. And it wasn't, it wasn't 160 miles a day or 100, I forget how much miles she was taking, but it was a lot. And it was obviously wrong. And that was, in my mind, that's why I believe that particular return was audited. It turned out okay. I mean, she got dinged a little bit for the car and truck expense.
So excess miles, that's why she got
dinged? She got audited because her mileage, it was just crazy. It was just way too high.
Is there any trade that you see that it seems like they get audited more than another?
For sure. I mean, cash businesses for sure are targeted more.
So restaurants,
restaurants, bars, and the corresponding sort of, jobs that go in those businesses. So like waitresses, bartenders, hairdressers, people that survive on a lot of tip income are going to have a higher incidence of being audited just because there's a lot of cash running around. And that's one of the reasons why the IRS wants, they want to move us into a more of a cashless society. Do you remember a few years back, Congress passed this really dumb law that said that for any transaction between two businesses in excess of like $600 a year, you had to issue a 1099. Now, at first blush, that seems sort of logical and reasonable. It's not, because there's I forget how much commerce exists in this country in a given year, but it's in the trillions of dollars.
And it's too much to do it for $600 a pop.
And what happened was the IRS realized that was going to generate billions of extra 1099s a year, and their computer systems couldn't handle it, and they were going to just choke on all that data. But they're trying to get us to that point where we don't use currency, we just use plastic, we use debit cards or credit cards or whatever, because they
want to regulate everything.
Yeah, their opinion of a utopian, society is where every single dollar that you spend can be traced, and therefore it can be taxed appropriately.
What's the likelihood of that, you think? I mean, we do a lot of stuff cashless, but I don't see it going away anytime soon.
In the next 5 years, I think the chances are zero. In the next 10 to 20 years, I think the chances are like nearly 100%. Because, well, if you watch science fiction sort of shows, I mean, they don't pull greenbacks out of their wallets, they just, I don't even know, they just kind of show up, and there's like a chip in their body or something, and that's how they pay for things. And,
See, there's some job security for Ryan after all.
Yeah, for sure. Like, get people de-chipped, right?
Yeah, your son wanted to be an attorney, so 20 years from now, when he takes over the firm.
Yeah, I don't think it's going to be 20 years.
Do things a little different.
Yeah, it might only be 15. He's, he's on his way. But, there's cash businesses get audited quite a bit. I mean, there are people that say that doctors, lawyers, and even accountants get audited more than other professions. I think it could be that, I've seen a lot of funny positions that doctors take. And I think one of the reasons is, and no offense to doctors, is a lot of doctors still do their own tax returns, which is really a bad idea. I mean, doctors are brilliant. I mean, they're really, really some of the smartest people in our society. There's just things that they should just stick to being doctors,
Well, I mean, that's the thing. Like, you wouldn't go to a CPA to get medical advice no more than you would go to your doctor to get tax advice. And you could be super smart, but there's law changes every year.
Yeah, for sure. Every year there's different changes and whatnot, and you just have to rely upon a professional that keeps up with that stuff. And there's actually sort of a complexity level that I think people should use a professional preparer. At some point, it doesn't pay to do your own return, because the $300 or $500 or whatever you're saving, you're not really saving, because you're not taking advantage of deductions that you should be. But worse, you could be taking deductions that are just absolutely ridiculous. But since you're using TurboTax, and it says you can take it, you're going to take it. And that's where, that experience and sort of discretion comes into place in using a professional tax preparer.
And they do look at self-return prepared, right? That's a target, your target, versus having a CPA's number on the bottom of the tax return, because, they're not really liable, but they are held to a certain standard where they're expected to only report correct information.
Yeah, I think we've talked about this in the past. And one of the things that happens is, there's little mom and pop sort of tax preparers in the neighborhood. I'm going to just characterize it as in the neighborhood. And they're not necessarily, even a professional. They don't have an enrolled agent certificate. They're not a CPA. They're not a lawyer, obviously. There's a dirty little secret, and that is that there is no education or special credential. There's no test to call yourself what's called an unenrolled tax preparer. So what I'm saying is
it like a bookkeeper? What
I'm saying is anybody can say, I'm a tax preparer. I mean, that's
kind of scary.
That is frightening. So what happens is the guy in the neighborhood, right? So he gets business by word of mouth, because he gets people the biggest refunds or has the smallest tax bills, right? And so what happens is there's continuous pressure on that tax preparer to perform in that way. And so word gets around.
Sing, monkey, sing.
And every year he pushes the line just a little bit farther. He just keeps pushing the line. He keeps pushing the line. And then we end up seeing things like I've been seeing recently, which is, taxpayers that are wage earners that get paychecks and have taxes taken out of their W-2. I mean, these guys are putting Schedule C's on their tax returns with big losses. So what that means in simple terms in English is they filed a return with the IRS like that taxpayer had a small business that was losing money to try to offset the tax so that they could then get a bigger tax refund. It's totally illegal. It's crazy. But they can get away with it for a while. And they can get away with it for a while, but what happens is every person who prepares a tax return professionally has what's called a PTIN. It's an identification number. And what happens is the IRS starts to pick up the anomalies from that preparer, and then they go and they audit
returns that they
every
did.
single return they ever did.
So the bottom line is look for an enrolled agent.
Either look for an enrolled agent, a law firm, or a CPA firm, or a reputable company like Jackson Hewitt, Liberty Tax, H&R Block. Those, the big guys. Those guys are pretty good. I mean, they're pretty good at the simpler stuff. But you just have to be careful about the neighborhood sort of tax preparer.
Well, you're listening to the IRS Solution Attorney Show. That sound means we have to take a quick break. We will be back in just a minute. Today's show is all about how to avoid an audit. So stick around. We'll be back in just a minute.
Welcome back to the IRS Solution Attorney Show. I am your host, Darrin T. Mish. I am the IRS Solution Attorney.
With the Punisher cufflinks and all. I'm your co-host, Katrina Madewell. Thanks for sticking around with us after the break.
Yeah, I do have a cufflink sort of fetish. I like to wear cufflinks because, men don't get to wear that much jewelry, right? I mean, we're kind of limited. Women can dress themselves all up with all kinds of shiny stuff, and men are kind of stuck. I mean,
you could do it too, but you might look a little funny.
Yeah, exactly. You look like Mr. T, I pity the fool.
So we thought we would share today's show on something that would apply to a lot more of our general audience versus just to only people that have an IRS tax problem. And so if you heard the earlier part of the show, you know that our topic for today is how to avoid an audit.
Yeah, so today we're talking about how to avoid an IRS audit, and it's really, kind of a universal topic because, I even want to know how to avoid an IRS audit, which is why I look at all my, people that come in with audit letters. I always look at their returns and try and figure out what the cause of the audit was so that we can not only prevent that in our practice when we prepare returns, but I want to prevent that in my return so that I don't get audited either.
And if you missed the earlier part of the show, you can catch the whole thing in its entirety on a podcast.
As well as our new app, which is called the IRS Problem Solver, and that app is available on iTunes and on the Android store.
Awesome.
Well.
And so part of the things in the earlier segment was understanding how you get chosen and who's likely a target.
Yeah, so there's some things. We talked about the DIF score, the discriminant income function score, and basically every position that's taken on a tax return is scored. And if you score outside of sort of the norms for your industry or profession, then, you have a lot higher likelihood of being audited. So one of the things, or some of the things that could cause audits are, large charitable contributions. That's one thing that's becoming more and more common.
What's considered large? Depending on how much you make?
I think the threshold is $250. But
what?
If you, if it's just really out of whack, I mean, we've seen things like, okay, the person's income is $100,000 and they're trying to maintain that their charitable contributions were $40,000. Well, that's kind of an interesting position. Not necessarily wrong. But, be prepared to have to
document.
Be prepared to be called to the carpet for that.
We talked about cash businesses too.
Mm-hmm.
If you're a business that takes in a lot of cash, you may likely be a target. And which leads us to our third one, which is incorporate if you're self-employed.
So when we're talking about being self-employed here, what we're talking about is somebody who gets a 1099, basically. Right? So let's say you're a plumber and you get a 1099 because you're basically contracting your services out to another plumbing company, or maybe more than one plumbing company, and they don't withhold any taxes, and you sort of get dispatched to handle plumbing problems. What I would suggest is that you go ahead and form yourself an LLC or a corporation, and the reason is that those returns, at least for corporations, are audited far less frequently than a Schedule C return, which is what you file if you are a 1099 self-employed sole proprietor type person. The last audit stats that I have seen for Schedule C indicate that something like 5% of Schedule Cs are actually audited. That's a pretty high rate. I mean, 5% is a lot. That's 5 in 100 people. So if we were in an auditorium or at a meeting or something with 100 people, there'd be 5 people there who were being audited in any given year. That's a lot. So that's a really high audit rate. Conversely, the 1120S or even the 1120, which is what returns are filed by corporations, those are audited in like the 1% range. So, I mean, that one thing can cut your audit risk by, an order of magnitude.
That's awesome.
Yeah.
Good little tip.
Yeah.
So really, for anybody self-employed or getting 1099s or extra income, it's a good idea for a lot of reasons to incorporate.
Yeah, there's liability protection. There's some audit reduction, audit risk reduction. There's a lot of things that make it a good idea. Now, you have to think about the fact that there are additional costs for being incorporated, too. There's there's like an annual fee that you have to pay the state. There's a tax return. There's there's an extra tax return that has to be prepared. So a lot of
but these things are tax deductible.
Yeah, they are. A lot of let's say you're making $25,000 on a 1099 and you're just living on $25,000. Probably not worth incorporating at that point because your risk. I don't know. The risk reward just seems kind of out of whack. And I don't know where the line is, but it's probably somewhere between $50,000 and $100,000 of revenue. It's probably a good idea to go ahead and be incorporated.
So I was looking at the next thing on our outline, number 4 is include explanations, and I'm ready to hear about this one.
Yeah, so in the past several years, I'd say the last decade, the IRS has really moved toward this sort of model where they want all tax returns e-filed, right? I mean, like, when was the last time you filed a paper return?
I don't do it at all, but I think it's been a long time.
Yeah, I actually filed one this year for some reasons for some urgency reasons I had to go file on paper, but it was actually a little bit faster, believe it or not. That's kind of weird, right?
That is weird.
But anyway, I had to file in paper, but you can include explanations for these kind of aggressive positions that you're taking. So back to our example, the couple earned $100,000 a year and they had $40,000 in charitable contributions. If they came to me ahead of time, I would say, well, definitely do not e-file that return. What we want to do is we want to file that in writing and on paper, and we're going to want to attach our documentation, our proof to the return with a letter of explanation. And what you're trying to do there is you're trying to head off the diff thing, So what's going to happen is because it's paper filed and there's some other documents there, then hopefully the goal would be you're moving that to a human being to eyeball it before the computer sort of looks at it.
So when you send the paper in, a physical person gets it versus e-file?
That's my understanding, and it has to be manually processed. And so the idea would be let's just head off the audit before it occurs. There could be lots of reasons why you would have a $40,000 charitable contribution with $100,000 of income. But it's weird. So you want to be able to document why this was like a one-off kind of thing.
So I'm sure there's a form, right?
There's not. You're just gonna have to write a letter, and you're gonna have to clearly explain.
And so, do you think that actually would diminish your chance of getting audited?
Absolutely. We've done things like that in the past. If you go ahead and include the documentation, what you're doing is you're sort of like almost self-auditing in advance. Because you're providing them your documentation.
So you're saying, look, I know you're going to look at this funny, but let me just tell you right now why I did it, and here's my explanation.
Mm-hmm. And especially if you're filing a return that's just really super inconsistent with returns you filed in the past, that would be another instance where you might want to go ahead and file with paper with a letter of explanation and try and handle it that way. Because let's face it, folks, I mean, getting audited it's really a bad thing. It really is. I mean, there's emotion. Even if you have the most perfect records, let's say you use, Shoebox and you had everything was perfectly right. There's still, there's a psychic toll, there's an emotional toll.
Oh, yeah.
Getting the audit letter.
You have to stop everything you're doing.
You have to stop everything you're doing, like right now, and you have to get all this, paperwork and documentation together. And you know what happens? Sometimes innocent people,
freak out.
Sometimes innocent people are wronged by the government. It happens all the time. I've seen it a million times. When I used to be a criminal defense attorney, there was plenty of guilty people who were set free, and found not guilty, but there was plenty of innocent people who were found guilty. The system is not perfect, and so you just want to avoid the audit if you can. There's some other things that I see that cause audits regularly, and that one would be unreimbursed employee business expenses. Now, what are those? Unreimbursed employee business expenses are where you're getting a paycheck, and for whatever reason, you're maintaining that there are expenses that you have to pay which are not reimbursed by your employer. Now, thinking about that, that's actually rather rare. Right?
Yeah.
It's rather rare. I could think of a few examples where, like, you work at Culver's, the hamburger stand, and you got to wear a uniform, and for whatever reason, they don't provide the uniforms.
Don't they usually? I thought they did.
Yeah, they usually do. But, I mean, I'm trying to...
If they didn't.
I'm reaching here to find an example. But if they didn't, then you could write off the cost of a couple uniforms. Not 10, not thousands of dollars, like a couple uniforms. And it's usually probably like a shirt and some pants, maybe some shoes, something like that. But most employers are going to handle all of their employees' business expenses. And we see it all the time. People put these crazy expenses in that line, and it just pops out an audit like almost 100% of the time. And the computer's really good. The diff score for that is low. Those amounts are very low, and it's going to depend on your profession or your occupation.
Do you
as
get
well.
to see what the diff scores are? Just kind of curious what the ranges are.
That would be so
okay.
killer if you knew, because you could just always.
I'm thinking like credit score in my head, of course. So
yeah, no, it's a top secret. I don't know if it's technically.
They're not
secret,
telling you the
algorithms.
thing.
Yeah, they're not going to tell you how the algorithms work. I'm an old SEO guy, search engine optimization, and at one point in time, I really had the Google algorithm figured out, and I could make websites rank really highly and stuff like that. And it's just the way my brain works. Is I love to
figure
learn,
it out.
I love to learn the framework of rules and then figure out where all the holes in the armor are, where all the chinks and stuff are. I love that. That's just kind of how my brain works. So if I could figure out the diff score, that would be, really awesome for our clients.
At some point you may, you never know. So you're listening to the IRS Solution Attorney Show. We have to take a quick break, but today's topic is all about how to avoid an audit. And if you missed the earlier part of the show, the whole thing's available via podcast, Android, or iTunes, and you can get it from the App Store. Just search for the IRS Problem Solver, correct?
Yep, that's right.
And if you want to reach Mr. Mish, it's 888-GET-MISH.
888-438-6474. That's 888-438-6474.
Stick around. We'll be back in just a minute. We're going to continue talking about how to avoid an audit.
Are you suffering from IRS problems? Do you owe back taxes you can't pay? Is your paycheck or bank account being levied? Or maybe you haven't filed tax returns in years and simply don't know what to do. This is Darrin Mish to tell you that if you're tired of IRS problems hanging over your head and are ready for a fresh start, we may be able to help. Call the law offices of Darrin Mish at 888-GET-MISH, 888-GET-MISH. I can help you file old tax returns, work to release tax liens or stop wage levies, even negotiate deals to pay off back taxes at a discount, sometimes for pennies on the dollar. Hey, let's face it, these days it's not hard to get into tax trouble. A divorce, failed business, health problems, you name it. The point is, IRS problems may be solved if you're willing to take the first step. Call for a free consultation at 888-GET-MISH. That's 888-438-6474. Or go to the web at getirshelp.com, because the one sure thing is, IRS problems don't solve themselves. So get Mish. 888-438-6474. Principal Office, Tampa.
Welcome back to the IRS Solution Attorney Show. I'm your host, the IRS Solution Attorney, Darrin Mish.
And I'm your co-host, Katrina Madewell. Thank you so much for sticking with us through the break. Hopefully today's topic in our show you find a lot of interest in, because I thought the outline was awesome. I mean, I don't know who doesn't want to hear how to avoid an audit.
Yeah, I even want to hear about how to avoid an audit. And every day, or it seems like at least every week, I learn a little bit more about how to prepare better returns so people are audited less frequently.
Go ahead.
I was going to say some of those things are just don't take ridiculous positions. Think about it. And, if you're going to use tax preparation software like TurboTax, just be careful. You kind of have to have
common sense.
You have to have some common sense, and you got to avoid that number. I think it's in the upper right-hand corner that tells you how much you owe or how much you got coming back. And don't make decisions based on that number. Make decisions based upon the correct answer. And at some level, you have to have a professional prepare your return. Otherwise, you're just going to stumble into one of these traps. It's almost inevitable. You're eventually going to get audited because you just don't know what you don't know.
The next one on our list is avoid filing amendment to your return. And I'm thinking about this thinking, well, I guess a lot of people probably don't file an amendment, but I'm sure there's a lot of good reasons why you would file an amendment to your return. But I had no idea that might actually trigger or flag you for an audit.
Well, it certainly could file or trigger an audit if you file an amended return, particularly if you're trying to amend the return from reasonable positions to ridiculous positions, right? I mean, that makes sense.
So let me play devil's advocate, right? And so, like, let's say from the real estate and the mortgage perspective, they don't quite have enough income, the self-employed person, on the last year's tax return to average those years out. So now they want to amend last year's, show a little bit more income. They're going to be writing a check and send it to the IRS. What's the likelihood, if they're paying more money, that they'll actually get audited?
Zero, probably. Or pretty close to zero, because the IRS is going to always love the fact that you reported more income and and no additional deductions, because it's going to result in you owing more tax.
So would it trigger an audit for the next year?
Probably. Well,
maybe.
I don't know. It depends on how sort of outside of the norm you were going. I have seen lots of positions. Well, actually, I have a client right now who he's, I won't even say what he does, but he's trying to maintain the position that he's living on less than $10,000 a year. I think I've told him this. I think on its face, that's kind of a silly position. I mean, you're going to be prepared to explain, how do you do that?
I'm a farmer.
Well, that could be the answer. If you're out there raising your own livestock and, growing crops and stuff, I guess that could work.
I'm pretty sure you were not expecting me to say, yeah, I'm going to amend my return to pay more money to show more revenue.
Yeah, I hadn't really thought of that, but in your profession, I mean, that certainly makes sense that people would probably do that. They're like, oh, yeah, oops, I forgot about that extra income. Because there are people who get 1099s, right? But then they get some cash or checks or things not on the side. That sounds like, illegal.
Sounds shady right out of the gate.
Shady. I don't mean that, but let's say they have one, they get a 1099 from like their main customer, and then the rest of their income is from smaller people that just don't know to issue 1099s or just don't bother, or maybe they pay them less than $600 a year, which is the threshold. And a lot of taxpayers would be really tempted to only report the amount that's on the 1099. Right?
Okay.
It kind of makes sense.
Yeah.
But remember, the IRS has special audit guides for dozens of different professions. I read the audit guide for how to audit attorneys, which incidentally, if you're listening and you want that, you can just contact the office and we'll send you a copy of that out. But they actually really understand how law firms work and where lawyers are tempted to, skim cash and stuff. One of the examples was criminal defense attorneys get paid in cash quite frequently.
Because the clientele they represent
might
not have a bank account. Which
I know from experience was pretty darn common when I was doing that kind of work 20 years ago, that a lot of people would pay you in cash, big rolls of cash typically. And a lot of lawyers are just kind of tempted not to let that end up in the bank account, And so, but the IRS is wise to that. They know that. And so they have some other techniques to try to find that money, or find the evidence that money existed.
We should do some future shows on like the audit guide for different professions. That would be really cool.
Yeah, that could be kind of neat, huh?
So if you're listening and you want to chime in and you want to know a little bit more, you'd like us to put together a show on an audit guide for your profession, just call us up at 888-404-1010, and Pat George back there will take your information and let us know. 888-404-1010.
I would say a lot of occupations that travel a lot get audited a lot. Real estate agents get audited a lot because you guys do drive quite frequently.
3,000 miles a month, easy.
And I would say the single most common issue that's audited is car and truck expenses, which really is mileage.
But
right?
You can't really do expenses if you take mileage, right?
Well, there's two ways to take, car and truck expense. You can take actual expenses, or you can take mileage, which is at a standard rate. And it varies by year. And I used to always kind of scratch my head and wonder, well, who would take actual expenses over mileage? Because mileage is going to win like 90% of the time. And I've seen some recently where actual expenses were higher. And guess what they did?
Real estate?
They were truck drivers.
Oh, truck drivers.
Makes sense.
Well, I was thinking like the car payment and expensive maintenance, which
the car payment's never deductible, like in the sense of business expense. But I'm talking just like repairs, fuel, maintenance, that kind of thing. In truck drivers, it makes a lot of sense.
But if you have a Tesla, can you replace that maintenance cost for the car payment? Just curious.
Well, I suppose if you used the Tesla 100% for business and you could prove that, then you probably could. I don't know what does it cost to what do they put like a new battery in there? No, there's no battery in a Tesla, right? What do they put a whole new electric motor in there?
It's Tesla is I don't know. There's a waiting list for the next ones that are like 40,000.
So, yeah, there's somebody here in the studio that's not talking that wants to tell me the answer, but he won't go on the mic.
Speak up and talk about the Tesla. We would love to hear about it.
He's going to pass on that. So anyway, there's some things like that could cause you to be audited. You just have to take reasonable positions, and you just have to, if you're if you feel like your tax return is complicated at all, you should get a professional to help you with preparing
Which that's
it.
going to be most self-employed people for sure.
Almost every self-employed person. The other people that their tax returns get kind of complicated are people with lots of rentals. I had a case recently. They were audited. And
wait, what's lots of rentals? Like how many properties?
This particular couple had 6 or 8 rental properties, and they were split between Oklahoma and Texas, and they live in Florida.
Okay.
And so they had a lot of deductions because they were self-managing. So they had a lot of travel expense because they were going to Texas and Oklahoma like quarterly. And what ended up biting them was they didn't make an election to group all of those properties to be treated as one sort of enterprise. And so they had losses. They actually had true legitimate losses, but because they had failed to make that grouping election.
So you're talking about like just personal returns versus.
Well, in this case, they weren't incorporated, so all these rentals were going on a Schedule E, which is like sort of like the investment.
So if they could do like an LLC with like a management type thing, that would kind of.
Yeah, that's what we're ultimately going to do to prevent audits of them in the future, because this is an issue that they're going to get audited not every year.
Which you would think they would
frequently.
want that anyway, like a separate bank account, separate everything, like just for that.
Yeah, so we're ultimately going to put them in an S corporation. And
is that for all the properties or individual?
I'm not actually doing that work. I referred them to, sort of more of a tax planning guy, but they could do it one of two ways. They could put the better, like, sort of asset protection vehicle would be put each one in its own entity, like in an LLC or in a land trust, which could technically work. But, that's a lot of administrative overhead. Yeah, a lot of hassle there. It might make sense for them to just throw it all in one entity. I don't think there was a lot of equity in those properties, so that's another consideration too. I don't think there's so much asset protection. But the way
Oklahoma.
Well, the way that they're set up right now, I was telling the taxpayer this. If you end up running over a bus full of school kids, you're going to get sued, and everything's gone. They're going to get everything because it's all in one basket.
Yep.
And
makes sense.
Really bad idea.
So another one on our list is file on time. How the heck is that going to keep you from getting audited?
There's some people that think filing on time keeps you from being audited. I'm not necessarily of that opinion. We file lots of, as you know, very late tax returns, and I have seen very few really late tax returns be audited. I have a theory in that, it takes a little bit more resources to audit a 2010 tax return than it does, the ones that are more frequent or more timely, like 13, 14, and 15. Are the years right now here in 2016 that are being audited super frequently. So I had a friend that was an IRS auditor. I knew her before I even started doing this work, and I asked her that. I told her that theory, and she just scoffed. And she said, that's not true at all. And that made me believe it was true, actually.
I wonder if we could get somebody from the IRS on the show. Probably not, huh?
Well, maybe. You never know. One never knows.
So be exact and be neat.
Yeah, like if you're using some people still fill out their taxes with like a pencil or a pen. And if you can't read the numbers, there's a good chance you're going to get audited because, this is one of the few times in life when neatness counts.
You got to be kidding me.
When I was in school, I was in grammar school and even high school, I used to get really poor grades in penmanship. And I think that just meant that I was going to be a lawyer and I was going to have to sign my name, 50 times a day because you can't read my signature either. But in this case, you have to be exact and neat. A tax return is one of those things where you're attempting to get to an exact answer.
So if your deduction for mileage is,
indecipherable, you're probably going to at least get a letter. Now, we didn't talk about this. There's different types of audits. You can have a correspondence audit. You can talk, you can get you can have an in-person audit. There's all kinds of different audits. And
so also never leave blanks. That was on the list too.
Well, never leave blanks on a line that has to have a number.
Gotcha.
Right? There's going to be lots of blanks on your tax return because there's just things that just don't apply. But I'll give you an example. From page 1 of the 1040 to page 2, at the bottom, there's a number at the bottom of page 1, and that number has to be the first number on page 2 because it's all just a giant math equation. It's really simple arithmetic for the most part. So you want to make sure that those types of lines actually have numbers on them. Otherwise, theoretically, the computer could kick out an audit notice because there's a line that needed to have a number that doesn't have a number. And
so what are the different types of audits?
So you can have an in-person audit, which is the scary kind where they say bring all your stuff. You can have a correspondence audit where a correspondence is just the IRS sends you a letter and they say, hey, we've got a question about the following positions that you had on your tax return. These are the most common. There often comes out on a letter called a CP 2000. I've had these, and it's a lot of times it's like the Social Security number for one of your dependents is wrong. That would be an example of a correspondence audit. Or
that's a simple fix.
Yeah, it could be, like math errors is another type of audit. It's not really an audit, but like sometimes there's arithmetic errors, literally, where people are doing, returns by hand, and that they just add up wrong, and that's going to trigger, an audit of sorts. And another audit that we haven't talked about is a substitute for return, where the IRS just prepares a return for you, is an audit of sorts.
And that is a complex topic that we are going to talk about after the break. And if there's any other types of audits that we missed, you're listening to the IRS Solution Attorney Show. We've had a great show lined up for you today on how to avoid an audit. And the whole show is available via the app at the IRS Problem Solver. We're also on iTunes and across the web. Just look for the IRS Solution Attorney Show, the IRS Problem Solver. Back in a minute.
Welcome back to the IRS Solution Attorney Show. I am the host, the IRS Solution Attorney Show.
And I'm your co-host, Katrina Madewell. Thanks for sticking with us for the break.
That was kind of robotic. My name's Darrin T. Mish. I'm the IRS Solution Attorney.
Just in case he forgets, I'll remind you guys. But today's show is all about how to avoid an audit. And we talked about a lot of really awesome things in court, especially like understanding the selection process, like how you're picked, how likely are you to be a target, incorporating yourself if you're not, include explanations, avoid filing amendments, and all kinds of other things. And where we left off was talking about the different types of audits that there are.
Yeah, basically there's a correspondence audit where the IRS just writes you a letter and they say, hey, we got a question about this, and if you don't answer it, within the time frame and we don't like your answer, then we're going to, assess you some additional tax. There's also an in-person audit. The in-person audit is the letter that says, okay, you're being audited, bring all your stuff. And then there's technically when the IRS prepares a return for you because you won't, or didn't file a return, that's called a substitute for return, and that's technically an audit too. Now, it's interesting to note that all audits you can apply for something called audit reconsideration. So if the audit, you're audited and the audit goes poorly, if you then file or find the box of records, that was in the attic or whatever later, you can go back to them with new information that was not previously, looked at during the audit, and you can apply for something called audit reconsideration. And sometimes that works. It works almost 100% of the time in the context of the substitute for a return, because by definition, they haven't looked at hardly anything to prepare that return, and that number is always inflated.
So I have a question. We've talked about a substitute for return before, but if the IRS has filed that substitute return, can you then file an amendment to that return? And then with your amended tax return, does that get audited?
That's a really good question. Because there was no original return prepared, you don't file an amended return, you file an original return. And that original return technically is
Does it just bump the substitute for return out of the way?
Yeah, it does. I mean, if that original return, is just silly, then they're going to just reject it. They're not going to, they won't process it. But I would say 99 times out of 100, they're going to go ahead and accept that original return at face value. And then if they want to audit that, they still have 3 to 6 years to audit that. So usually they accept them, unless, again, it's just kind of a silly kind of thing. And I've seen some that are just silly, but most of them aren't.
Well, you're listening to the IRS Solution Attorney Show. If you missed any part of today's show, I would highly encourage you to check it out in its entirety. It was all about how to avoid an audit. And so you guys have a new app over there
called the IRS Problem Solver. It's available right now on Android and the Apple Store, and is coming soon to the Windows Phone Store. I don't know what it's called.
Which is funny, but it's coming, so that's nice to know. We do have some questions from some listeners. Let's get to that real quick before we have to talk about the train wreck of the week.
That's great.
Ravi wants to know, will calling the IRS help me get an amended return processed any faster?
Probably not. Because amended returns sometimes, it depends on the issue, I think, on the amended return. If it's a simple issue, it's going to take anywhere from 30 to 90 days. If it's a more complex issue, it could take a year, for the amended return to be fully processed. I don't think calling them would probably help, but you could actually file what's called a Form 911 with the Office of the Taxpayer Advocate. So you just Google Taxpayer Advocate Service with the IRS, and you'll find Form 911. And when you fill out that Form 911 in this context, what I would complain about is hey, I filed my amended return on January 1st. It's now October 1st. This is taking too long and nobody will give me the answers. Please expedite the handling of the amended return. What will happen is the IRS will actually assign someone called a taxpayer advocate, who is supposed to be, and in my experience, is sort of a separate, neutral person there to help you. And what's great about that is the IRS. When you deal with the IRS, you don't usually get a single person, like a single point of contact, and that's what the taxpayer advocate does in that situation.
So one more quick question from Janice. She wants to know, what should I do if I entered an incorrect routing or account number on my direct deposit on my refund?
Call the IRS.
Call
the IRS and give them the right routing information. It will probably still stay screwed up, and it just is what it is.
So we have a headline story we have to talk about, just because we have to talk about it. Charlie Sheen, he's got a nightmare. He's under audit.
Okay, so my opinion of Charlie Sheen is just basically the guy's a train wreck, and he's a train wreck because he's got some other stuff that's going on in his life.
He's always been a train wreck.
Higher priorities. The guy makes tons of money. And yeah, I guess he's being audited by the IRS, and it just is what it is, and he probably doesn't care.
So do we know why he's under audit? Just curious.
No, I'm not really sure, but he probably filed tax returns that just maintain, ridiculous positions. My best guess is he's writing off stuff that's kind of wacky.
Probably writing off prostitutes or stuff like that.
Well, I didn't say that, but
I did.
But you did.
Leave it up to me.
Yeah. Charlie, don't sue me. Sue her.
Sorry, I did it. Yes, But he's got that wild, like even 2.5 Men. He's got that wild.
Yeah.
What's a good word for it? Personality. Like how do you the male?
Yeah, he's got a crazy persona going on. I don't know if it's real or not, but his rep is pretty interesting.
All right. It's about that time.
It's about that time for the IRS Train Wreck of the Week. This is the segment of the show where we talk about somebody who came into the office and they were basically a train wreck. They had a huge IRS problem. And the great thing about the segment is they always leave with a happy ending. So in this particular case, I was representing a dentist, and he was a non-filer for many years. And what we did is we got him. We went ahead, and the first thing we did is we prepared all of his tax returns. And we prepared all of his tax returns, and he ended up owing about $500,000. I don't have the exact amount here, but he owed about $500,000. And so what we did is we filed an offer in compromise. An offer in compromise is where you make a deal to settle for less with the IRS, and it's based upon a relatively simple math equation. And in that case, what we did is we offered about $12,000 because we try to always lowball the IRS because we know that during the negotiation we're going to go up a little bit. So the IRS rejected that offer, and they came back and they said, really, he can afford a full pay, which was really a crazy situation because he wasn't making that much money. And he was making about $80,000 a year, and he had wife and kids and stuff like that. So he decided, and we decided jointly, that we were going to go ahead and file an appeal of that offer and compromise. We waited for a very long time before we got to discuss that with a settlement officer. And what happened is we ended up having to threaten bankruptcy to the IRS. Because this particular guy, all of his stuff lined up perfectly to where if he had filed a Chapter 7 bankruptcy, he would get a discharge and he would owe the IRS absolutely nothing.
So how do you threaten? You actually have to file that number? File and get a case number or no?
What I did is I went ahead and I put it in writing, and the IRS appeals officer had to consider it at that point because the Internal Revenue Manual says that he has to. He says, well, Darrin, do you really think he's going to file bankruptcy? And I said,
I got the paperwork ready.
I said, if you owed $500,000 and you could push a button and make it go away, would you file bankruptcy? And there was this long, pregnant pause. And I said,
how fast can we settle?
And I said, I'm not going to make you answer that question. I can tell you that I would, in this context, I would file bankruptcy. And second, long story short, we ended up increasing the offer to $25,000. The settlement officer thought about it for like 6 months. Came back, accepted. So it was $25,000 on about $500,000, and that taxpayer ended up paying 5 pennies on the dollar.
How long was this whole process?
Probably took about 2 years for that particular case. But that was a big case, and he was a non-filer for over 10 years. So there was a lot of work had to be done on the front end to get him in position to get that done.
Well, that's all we have for this week. You're listening to the IRS Solution Attorney Show. We really enjoyed having you this week. We hope you enjoyed our show on how to avoid an audit. And if you haven't already checked it out, the whole thing's available on a podcast, and get the app, the IRS Problem Solver.
Absolutely.
This week,
For this week, I'm out.